Today I wanted to spend some time with all of you to discuss why use a radioactive trade. What is radioactive trading? Why should you consider using it in your portfolio? Why do I use it? Okay, I have many of you know that over the past probably 6 to 7 years, I've been trading the radioactive positions in my personal account since we got connected with Kurt. At any time, maybe about 50% of my portfolio has been allocated to the radioactive trading. Why? Some investors, some customers say that makes, maybe I'm just trading that because I work for power options and for radioactive trading, and that's the only reason why I say that I do it. That's not true. These are actually my real trades. Fusion subscribers see my actual trades in my Fidelity and Options Express account and implementing them with the radioactive trading techniques. But what we're here today for is to discuss why you should consider using this, why you might use radioactive trading techniques in your portfolio. Now, for those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. Power Options, of course, is a patented suite of search and analysis tools designed for self-directed options investors. We support tools in over 23 of the most commonly used option strategies. Power Options has been around since 1997. I've been working with Power Options since 2001, and I've been trading in the options market since that time. So about 14 to 15 years I've been investing. All right. What I want to cover today is I want to cover the main problem that investors face, why we haven't solved that problem, why we use radioactive trading to solve that problem, and some of the possibilities with the radioactive trading techniques in a real portfolio. Okay? What is the main problem we face as investors? Well, it's obvious, isn't it? We don't know the future. If we knew where the market would be today, if we looked back to the middle of May, we looked back last month to May 15th, May 10th, May 1st, if we knew what the market would have been, we all would have traded very similar positions, knowing which stocks would have been up, which stocks would have been down, and of course, which stocks maybe stagnated. But if we knew the future, if everyone in the market knew the future, it would already be priced in. In any strategy, if you're just buying stock, if you're doing covered call positions, if you're doing spread trades, if you're buying calls or buying puts, speculating on a market movement, there we go, folks, sorry about that, then you know you're going to have strings of winners and losers. Doesn't matter which strategy you're trading. You're always going to have that one that just breaks away from you, maybe in your positive direction, and doubles or triples the returns you expected for your strategy and your trading plan. Whereas others, you might realize losses 5 times, 10 times larger than you originally expected just due to the fact of the stock or the security moving in the opposite direction. Many of us know that the losses are sharp and quick. When we do suffer a loss, it's likely going to outpace the gains, where the gains in the market that we have are usually more gradual. Most of us have traded long enough that we know that we're not going to hit a home run on every trade. I had a conversation the other day with an investor who only trades out of the money call options that are under 15 cents ask price. And by out of the money, I mean as much as 20% to 15% out of the money or more. His trading plan is that he realizes he is going to lose 90% of the time. 9 out of every 10 trades, he's going to lose the full capital that he allotted to those out-of-the-money long call positions or long put positions based on his market sentiment. But he's hoping that the 1 out of 10, the gain on the 1 out of 10, if he gets a 10% gain, a 1,000% gain, or a 500% gain, is going to try to outpace the losers. Most of us don't have the stomach to trade that way, and I don't even know if he's successful. He's had some successes during given months, and other months he hasn't had successes, but he's just waiting long-term to see if that plays out. Not something that I would do, and not something a lot of us have the stomach to do as well. We are going to take losses. We all know that. We're going to suffer positions where the same criteria that produce 10 to 15 successful trades in a row is not necessarily going to produce 10 to 15 successful trades 2 months following the road. In trading, as in anything, math doesn't behave the way we expect to. If we have a 10% loss on a position. If I invested $10,000 into just a stock position, and the stock falls 10% and I get out with $9,000, a 10% gain on what I have left does not get me back to break even. I need an 11% gain on that position to get back. And this just gets steeper and steeper. This is what we call the martingale gambler's ruin. If I entered a covered call and I had a 7% stop loss on the position, and something happened during that time, not related to earnings, just some bad news comes out and the stock dropped 25%, well, my stop order is going to get triggered, but I'm not going to get out at 7%. I'm going to get the 25% loss. So now I'm going to need a 33% gain on what I have remaining just to get back to break even. And of course, if we suffer a 50% loss, say on a credit spread or a leverage long call position, we need to make 100% on what we have left in the position just to get back to break even. In simple math, if I put $10,000 into a stock, it collapsed 50%, sure, I might consider averaging down or doing something along those lines. But if I sold to close the stock and I've got $5,000 remaining, I need a $5,000 gain on my next investment of $5,000 to get back to break even. But the control is important. If I suffer a 5% loss on any given position, I don't need a 10% gain to get back to break even. I only need a 5.3% gain to get back to break even. As we talked about, in those situations where you're using a stop order or a trailing stop, in the case of an unexpected event, the stop order does not protect you. A stop order is assumed insurance. Okay, so why hasn't the problem been solved yet? Quite simply, we look in the wrong place. Okay? Many of us have been promised that by trading certain strategies, let's say covered calls, we could earn 3 to 6% per month. I don't care if the stock falls. I just keep writing it. I'll just keep writing calls and writing calls. If the stock falls 20%, so what? I'll continue to write calls at a lower strike price. I'll continue to generate 3%. I don't care about the underlying value of the stock. Yes, I do. If I open 10 covered calls in my portfolio and the market has a downturn or 5 of those stocks pulled back, and I see that my account has dropped from, let's say, $50,000 to a market value of $35,000, I don't care if I can generate 3% on my remaining positions. I am not happy with what I've seen. Those of you who trade spread trades, you know this inside and out. Spread trades offer you the possibility to go deep out of the money, find a nice leverage return with a good probability of success. We could use power options right now to find probably 10 or 15 trades that expire next week on a weekly position that are offering an 80% probability, an 11% leverage return. But what does that mean? That means that if I'm taking an 11% return, which would be 50 cents off of a 5-point bull put or bear call credit spread, I have a 9-to-1 risk-reward ratio. I'm risking $4.50 to make 50 cents. If I take one loss for some unexpected event, that's going to wipe out 10 previous trades. Okay, so is that a long-term successful plan? Well, it could be if you pick the market direction. But the market's ever changing, and you have to be able to adapt with that, and it's very hard to control the losses on those 8-to-1, 10-to-1 risk-reward ratios with the spread trades. Plus, these types of strategies that are very popular cap the upside gain. If you do pick the direction right on a covered call, and your stock moves up 7, 8, or 9% without putting more money into the position to roll the call, you're not taking advantage of that further upside movement. And on a spread trade, sure, I could take a bull put credit spread that offers an 11% return. If the stock moves up 10%, I just make that 50 cents and that's it. Now, all that being said, I do use spread trades in my account, but with a very small percentage. Only about 10% of my personal portfolio is allocated to spread trades, and I only do it on the broad-based indexes and ETFs. Okay? Well, I already talked about the covered call selling. Not going to spend too much time on this. We know the covered call caps the gain. I want to bring up an interesting story. When I first started with power options about 14 years ago, we were working directly with 2 groups out of Texas that advocated covered call selling and covered call trading. They did weekend seminars to teach you how to do covered calls, and they had management techniques for when the stock goes against you. One, really focused on trade allocation, and the other kind of focused on you don't worry about if the stock goes down, just keep selling your calls. It's a recipe for disaster over a long period of time. I was amazed at how many investors would call us up. They were using our tools the Power Options tools to find their covered call trades and track them with a portfolio. And even though these people paid $2,500 or $3,000 to learn how to trade covered calls the weekend, they were calling me up and saying, hey, this position's really down. What can I do to protect this position better? And at the time, I'd say, oh, well, you could look at a collar. Standard collar, of course. I buy stock, sell an at or out of the money call 1 month out, buy a put out of the money 1 month out, still collect a positive premium in. So maybe I'm looking to make a 2% return to the upside instead of 3%, but I've capped the risk to the downside to maybe only 4 or 5%. Okay? So you buy the put out of the money for some quick insurance, make sure that the call premium you receive is higher so that you do have a nice risk-reward profile. But that didn't solve their problem. What they wanted to hear was, Mike, do you have some magic thing where I can generate more income from this covered call position and still protect the downside? Well, no. If you do any kind of selling a naked put against a covered call, you create a covered combination. But now you've got to put up the capital to cover selling the put. You've got twice as much risk in the position. Well, if you enter a bull put spread, does that solve the problem? Not really. Because a covered call with a bull put spread, the put that you buy in the bull put spread only solves one problem of insurance on the naked put or on the covered call. It can't solve both, so you still have the same amount of risk. You have to pay out the money to get the insurance that you want. And the spreads we've talked about as well. Any kind of bear call or bull put credit spread, you have a capped gain. Of course, you can manage the positions, but if you're looking for those 80% probabilities or higher, you're going to end up with a position that, of course, has that 10 to 1 or 11 to 1 risk-reward ratio. And the problem with that is, again, one loss can wipe out 10 previous gains, but in addition to that, you're going to need to be right 85 to 90% of the time, consistently, in order to make a profit. And that's really tough to do. Now, what I want to do now is we're going to jump over and look at this mathematically. We're going to go over to RadioActiveTrading.com and we're going to look at the Simple Resources tab there to take on the Trade Simulator tool. Okay, so when we go to RadioActiveTrading.com, just click on the Resources tab up here at the top, and down below you'll see the Trade Simulator tool. Now let's talk about an average covered call position. Many of you might be trading covered calls. Let me do this first. I'm sorry, folks. I just have one poll to ask you today, and I just want to know what types of option strategies are you trading right now? Are you mainly looking at covered calls and naked puts? Are you doing vertical spreads, bear call credits, debit spreads, bull call debits? Are you buying calls and buying puts, speculating on market movement, maybe doing straddles and strangles? Are you doing calendar spreads? And if you answer other, I just put that in there, and you can answer more than one. But if you answer other, just send me a quick note in the question pod there to let me know what other strategies you're trading. Okay, folks, so we've got a lot of our answers coming in. I've got about 50% of you voted. I'm going to leave the poll open for another 10 or 15 seconds, so I do encourage you to vote. And again, William says he's doing married puts. Okay, that's fair. I was expecting that. That's one of the others there. I didn't put it in there specifically, but just wanted to see it. All right. So we've had the poll open for about a minute. I'm going to go ahead and close the poll so that we can move on here. I'm going to share the results with everybody. All right. Okay, so 38% of you, a little bit more than a third, are doing the covered calls and naked puts. 54% of you are doing the vertical spreads, credits and debits. 31% of you are buying calls, and even 15% of you are doing the calendar spreads. Okay, and then of course 15% said other. Some of you might be doing butterflies or iron condors, which sort of count in the credit spreads. William had mentioned he's doing married puts. John put in that he's doing collars as well. Okay, so let's talk about a long-term trading plan and long-term goals. What the Trade Simulator tool allows us to do is just simply put in what is our expected target for a return on a given strategy. What is our loss limit? Where are we going to put our losses on the position? What is our probability that we expect for winners versus losers? And of course, what kind of starting amount are we going to use as well? Now let's take a covered call strategy. And let's say that on average, I'm going to go to the high side actually right now, but on average, I'm expecting to make a 3% return for a 1 month out covered call trade. If I get assigned, the maximum return is 3%. From doing weeklies, might be around 0.8%, 0.7%, which might come around to about 3.5% over a month period. So we're going to go with 3%. Now let's say that we're following the rules, the common rules of Investors Business Daily, William O'Neill, other strategies out there which suggest that you limit your losses to only 7% or 8% with stop orders. I'm going to take 7%. Now, the probability of loss. How many winners do we expect? Well, let's say we're going to the high side, and we expect to be right 65% of the time on our covered call positions. So close to 70%, 7 out of 10 positions, we're going to get assigned and earn our 3%. And the other 3.5% of the time, or times, we're going to lose the 7%. Okay? Do you pick winners 65, 70% of the time? Let's find out if that works for you. Now, I'm actually going to increase our starting amount up to $50,000, which we'd need because we're buying stock in a position. And by the way, this criteria is similar to what we'd use for a cash-secured naked put, although the target return might be expected more around 2% for an out-of-the-money naked put versus 3% for a covered call trade. And we're going to invest maybe about 20% in each position. So, so we could open 5 covered calls, maybe 6 covered calls. Maybe we'll do 15% or so, but let's keep it at 20%. Oh, probably lost only 35%. Thank you, Alejandro. My fault. I always go reverse when I show the trade simulator tool. Just the way my mind works. I see loss. Okay. All right. So there we go. We're only going to lose 35% of the time. Thank you, Alejandro. We're going to make $50,000 as our starting account and so forth. Not even going to include commissions. Let's go ahead and go through this. All right. So we see what this tool did for us is it gives us a string of winners and losers in our portfolio. Okay, so we started off with a first loss. We invested 20% of our capital into one covered call trade. We lost, so our account's down about $49,300. We had 2 wins in a row at 3%, so that took us up. Then we lost a couple more times, and it's essentially flipping a coin. Okay, and we go through our strings of winners and losers. Now down below, we have the track record. So we were right 64% of the time. At one point, we did take our account. After strings of winners and losers, we would have gone up to about $50,258. But after 100 trades, 100 flips of the coin, even being right 65% of the time, we're down to $44,000. Okay, so we're down almost 10%, a little bit over 10% from our starting value, even being right 64% of the time. So let's run this again. Let's clear out those drawings there. All right, there's one at 65% of the time. We're still not winning. Okay, we did go up to about $52,000. We would have looked like we had a winning track record even after the first 5, 6, 7 trades. Here we go, 10 trades in. We're looking really good. But long term, we're going to see that we're going to end up at the same place, even being right 65% of the time. So what's the answer? Let's be right more often than wrong. Okay, so let's put this at 25% probability of loss. We're going to be right 75% of the time. All right, so after 100 trades, covered call positions being right 75% of the time, making 3% when we're right, using a stop order at 7%, assuming that you only took a loss of 7% on these positions, meaning if you didn't have a sudden gap down in the pre or after market hours where the stock dropped 15, 20%, your stop order was triggered and you got filled at that maximum loss there. And that's a bold assumption. But it's also a bold assumption that you're going to be right 75% of the time. That is difficult to do. So we might say, well, do we have to change the investment? Not really. Do we have to increase returns? Well, we could look for more volatile positions, but as we know, if we look for more volatile covered calls that maybe offer a 5 or 4% return even, we're going to suffer losses probably more often than not. We're probably going to be closer to a 40% loss probability to 60% winners, and that's still not going to pan out. So could we control the loss and limit it to only 5%? Well, okay, let's do that and keep the 25% probability of loss, and now you see the numbers you're hoping for. You take a $50,000 account, maybe up to $68,000. This is kind of sort of what a collar portfolio would look like, but look, we still have to be right 84% of the time. 78% of the time, I'm trying to find one that drops out. There we go. 70-30, we make a little bit over 10% gain. That's a lot less than the compounding promise of 3 to 6% per month and compounding that over time, isn't it? It's probably not the gains that you were expecting. And this is what's possible. And let me remind you, if you open some covered call positions, you open 5 today, and you put in a target return of 3%, you find positions offer the 3% return if assigned, and you put in a stop order at 5%, you're getting closed out of your positions a lot more often than 25% in normal market conditions. That trigger is going to click more often, and you're going to get out with more losers at 5%. All right, so covered calls might not be the answer we're looking for in a long-term portfolio, even if we try to tighten our restriction on our stop orders. By the way, this sort of risk-reward ratio here of making 3% when you're right, or 2.5%, I'll say, and 5% when you're wrong, and I'm going to put in 40 here, okay? And let's see, I've got a little bit more. That's what I want to see. This is kind of what I look for with the 10% of my portfolio to also trade with standard collars, what I described earlier. But you can see, even being right 68% of the time, you can expect a profit, but it's not very high. You've got good insurance in place, but you take down the target of a covered call, but it's still not getting us to where we want to be. Let's talk about those of you, of course, the 54% more than half of you doing vertical spreads. I gave an example of a vertical spread. Maybe I'm looking at Amazon, or I'm looking at Netflix, and I'm looking at a bull put spread where I'm going to sell an out-of-the-money put and buy a lower strike put with the same expiration. It gives us a risk-reward profile similar to what I'm talking about with a standard collar. Let me just draw this here. So here's my short put, here's my long put, and the stock price is probably up here somewhere. Okay? What I'm hoping is when I sell the put and buy the put, the stock stays above the strike prices, both options expire worthless, and I keep the net credit. My risk is the difference in the strike prices minus the net credit. Okay, so let's say we have a stock trading around $500, and I sell, let's call it a 480 put, because I'm expecting the stock to stay up above 500, or at least above 480, and I buy a 475 put. Between the two, I make 50 cents net credit. Okay? Now my risk is actually only going to be $4.50. My broker might only require me to put up $4.50 because that would be my true loss. If the stock falls below $4.75, I have to buy shares of stock at $4.80, sell them at $4.75. We take the $5 loss. The 50 cents stays with us, so I only lose $4.50 on a chance to make 50 cents. That gives us an 11.1% gain. Now we know that the stock could fall at any time. It could drop below and go down to somewhere between the two, to 479, 478. I never want to take the full loss on a credit spread if I can avoid it. But again, if the stock has a 25% decline in the pre or after market hours and drops below 475, I'm essentially at the maximum risk. So what does that mean? Well, let's take a standard credit spread portfolio, and we're going to look at 11.1% return on investment. My loss limit, though, the maximum loss, remember, was $4.50. I may suffer the full loss in some situations. I may try to manage the loss, but if the stock falls, I'm likely probably going to close the position and have to pay $2, $2.50, or maybe $3. Not the full loss, but still a fair amount to liquidate the position. So we're going to put our loss at 50%, which is probably kind of accurate. At the same time, let's just put we're going to keep this 20% here allocation in each credit spread we open on our $50,000 account. But when you look for this type of position, you're probably excited about the leverage of only putting up $450 to trade one contract. And you're also probably excited that you can find positions that have an 80% probability or higher of expiring worthless. Okay, that's the allure of these sexy credit spreads. I can make an 11% yield and have an 80% probability of success. But even with limiting the losses to 50%, we're not taking the full loss in any position, but remember, that's only taking, I make the 50 cents, the stock falls, I close it for $3 or $2.75, so I have a $2.25 loss. That's half of the margin I would have expected to lose. And with allocating 20%, here we're right 78% of the time, and our portfolio is almost down 50%. All right, so here we are at 81% even with this win-loss ratio, and we're still down. At one point, though, we had a huge gain. We could have taken our portfolio up to $72,000, but then we're going to end up potentially long-term at a loss, even being right 80% of the time. I'm going to find a winner here. There it is. 85% wins. I have to be right. When I look for those out-of-the-money credit spreads that offer that 80 or 85% probability, I do have to be right 85 to 90% of the time to make it pay for itself long-term. Okay? That's the lie of leverage. Leverage works both ways. Sure, I'm right 85% of the time, but on those 15 times I lost, I may have lost 50% or even 100% of what I invested into the spread trade. So, what is the answer? Well, let's talk about what we do here at RadioActive Trading first, and then go on from there. Our solution, the initial setup of the RadioActive Trade, is we're going to buy shares of stock. Okay, it is capital intensive, but we're going to buy shares of stock, and at the same time, we're going to buy a put option that keeps our risk within single-digit percents. The losses are limited, the gains are unlimited. Okay, it's commonly taught as buy stock, buy an out-of-the-money near-term put. So if I was looking at a $50 stock today, many investors and many gurus out there would tell you, oh, if you're going to use a protective put, you're going to buy the 45 put for the July expiration. You only want to pay $1 for the insurance. That doesn't put the risk-reward ratio in your favor. Buying an out-of-the-money put for a lower price gives you a lower cost basis, but the insurance doesn't kick in until, in this case, the stock drops 10%. The stock would need to drop down to 45 before that insurance starts helping me. Okay? It also doesn't put time value in our favor. Okay? The approach that we use is going to take advantage of what we call the 3 core principles, which apply to any position. We're going to review those in a moment. The basic rules of any trading, though. We never want to overtrade or overinvest. As options investors, we're manipulating time value. Whether you're selling premium, your true profit on that covered call position, the bear call credit spreads, is the time value and the time value decay. When those of you who are buying calls, 31% of you buying calls or buying puts, you're trying to limit the time value, but at the same time, you're trying to give yourself enough time for the stock to move in your desired direction. Okay, you need to use the time value in your strategy to your advantage. Okay, so the whole radioactive trading technique is the result of Kurt trying the covered call technique, learning how to trade spreads. He paid $3,000 for one of his weekend seminars, and in less than a year, he gave up most of his life savings due to the problems I just mentioned. Overtrading, getting into a bad strategy, and hoping that things would work out and not having a great exit plan. The setup that he decided to use, using the radioactive married put setup that we apply, is designed to take those 3 things that we want to see and apply them properly to have that limited risk position with the unlimited upside, but then we're still going to use other adjustments to manipulate the time value. Our focus is going to be on limiting risk first, not the return. We want to focus on limiting the risk first so that on any one position we can't lose more than, let's say, 4 to 8%. Initially, we want to leave the upside open. If we're right and the stock moves up as we're expecting, we are looking for bullish stocks, but there are ways to play this in the reverse. And there are also ways that we can adjust the married put position, the radioactive trade, if the stock moves against our expectations and drops in price after we open the position. We also avoid the lie of leverage, and that's key. We might talk about that a little bit later. We will talk about that in comparison a little bit later. Many of you who looked at that profit and loss chart of the married put said, oh, that's just the same thing as a long call. It's not, and we'll explain why in a little bit. The initial setup and all of the adjustments we use are going to put that 3 concepts in our favor. How? As I mentioned, we're going to purchase a stock in ETF. We're going to assume bullish. We are going to purchase a far out in time in the money put option. We're going to go at least 5 months out, and we're going to know no more than 20% in the money. Okay, we look to limit our risk to single digits. This factor here, this little one here, you say, okay, well, he already talked about why he wasn't buying a 1 month out put that's out of the money, but why go 5, 6 months out in time to buy a put option? Why pay that much? We're going to look at those numbers in a minute, but those of you that are trading long calls and long puts know that the time value factors in our favor when we buy further out in time. Those of you who are selling, the time value is in your favor when you're selling. We've already seen some of the problems that come with those popular selling strategies of covered calls and credit spreads. All right. A trade that I was already in, but a trade that came up and the default RPM report and the radioactive search for potential married put positions was Texas Instruments. Back on May 16th, we could have bought 100 shares of Texas Instruments at 58.05. Following the rules in the blueprint and radioactive trading techniques, I would have bought the far out in time January 2017 60 put. Is about 240 days out in time, about 8 months out, for $5.40. My total invested would have been $63.45 per share. My guaranteed exit is $60, so my maximum at risk, the most I could lose in the worst case scenario, is 3.45% or 5.4% as well. Okay. Ken just asked a quick question. What happens if a married put expires? Is there a commission? Number one, I try never to take the married put position all the way to expiration. We might talk about that a little bit on Tuesday. I'm going to manage the position or close it early. Is there a commission? Yes. If you did leave the position all the way open through expiration, if I did nothing, let's go to the next slide here. Well, I'm going to go to the next slide, and then I'm going to go back to one slide there. So for Ken's, here's the profit and loss chart of my married put position. The blue line shows us at expiration, at January expiration. So Ken, if I held this position all the way to January expiration and the stock was trading below my put strike price and I did nothing, my broker would exercise the put. Oh, I'm sorry, I just noticed something terrible here. I'm going to fix that in a minute. My broker would exercise the put option. I would sell to close my shares at 60, and I would take the full loss that we just saw. Okay? Was there a commission? Yeah, my broker would consider that selling to close the stock. I'd pay a stock commission to close it. At least at Fidelity I do. Okay, and then there might be an extra price as well. It's not 2 commissions, it would be just 1, because you're essentially forcing someone to buy shares of stock, so it would count as a stock sell commission. That's what happens to me. All right, let me go back one slide. What are the common detractions of this position? Well, they're obvious, and you've already probably thought of them, and you've already probably asked them of yourself. Number 1, I'm adding too much cost to the initial stock price. Why would I add that extra $5.40 to a position trading at 58, so my break even is now 63.90, 63.45? Well, because we all know the cost of not having insurance. We showed that already with the covered call position. Not having insurance in place, if I take that 25% loss because I had a 7% stop order and the stock gap down 25% and I get filled at the worst possible price, I need the 33% gain on my next position to get back to break even. If you're on a covered call and you're estimating a 3% gain, that's 11 months of management, hoping the stock stays at the same price or moves up a little bit so you can get that 33% back. Am I taking away from potential gains? Well, the gains are going to be limited due to the cost of the put. Okay, well, aren't your gains limited also in a covered call position? If my stock moves up 8% on a covered call, I would only make 3%, or I'd have to pay more to roll the position. On the put option, yes, I have 2 working legs. I have a stock that's moving up and a put that's moving down. But the way we structure the trade, we always have a positive delta. So as the stock's moving up, number 1, the delta on the put is always dropping, so I'm getting more as the stock keeps moving up and up and up and up. But sure, if you entered a stock position, the stock moved up 10%, I entered a radioactive trade on the same stock and it went up 10%, I might only really make 6%, expect to make 60 to 70% of what the stock would do, where you'd have a 10% gain. Great. But if your stock dropped 10% in the first month and you didn't have a stop order and you closed it out for the 10% loss, my stock dropped 10% and I still had 8 months, 5 months of time remaining, I could close that and I wouldn't be at the full loss. I'd probably be only a 3 or a 4% loss as well. And the other thought there is the stock cannot profit until the stock is above 63.90. That's not true either. Okay? When I open the married put position, let's go to the profit and loss chart now. And I apologize for this. It didn't update what I wanted it to. We know the risk was around 5.4%, okay? But this would be $60 per share. All right. Here's the risk-reward profile of this position. And I had Asim ask a question that I might try to navigate to. I'm going to show Asim an example of your question a little bit later on, okay? All right. But here in the married put, the blue line is my profit and loss at expiration. As we just mentioned to Kent, if I held the married put all the way to January expiration, chose to make no adjustments, and somehow chose not to receive the dividend on Texas Instruments, and the stock was trading below $60 per share, then I would receive the full loss and only then. If the stock gaps down 80% tomorrow for some unexpected event, well, I might be very close, of course, to that full loss as well. But that's okay, because I was in a stock that dropped 80%, and I only lost about 6%, 5.1%, or 6.1%, all right? The curved red line is showing me the profit and loss at the halfway point. In this case, it was September 30th. When I open the married put position, I am not down 5.1, 5.2%. Okay, I'm not down this 345 immediately or 5.4%. The minute I would have opened this married put on May 16th, I could have turned around and sold it, maybe got 58.02 for the stock, and maybe some slippage, got 535 for the put. Okay, so all I'm risking is the bid-ask spread on the put option. I am not down 345. I'm not 345 behind the 8 ball when I open this position. I could turn around and liquidate it right away. If the stock moved up $1 the next day, my stock would be at 59.05. My put would probably only be down to 490, 480. So I could close the position and take a 50 or 60 cent gain. Okay, that's the idea. That's not what I'm looking to do. I'm looking for bigger returns here, and that's why I've left my upside open, but I've controlled my risk. So if they even take that 5.5, that 5.4% loss on the position, I only need a 5.8 or a 6% gain to get back to break even. I'm putting the market odds in my favor. Right? Now, Asim asked, can I initiate the position with selling a put first? We're going to go through an example of that in a little bit. I'm going to be real quick here going through the 3 core principles. The common detractions, the common thoughts when an investor sees the married put is, well, I know better than Mike, or I know better than Kurt. I see what they're doing and I understand they're limiting risk. That's great for them. But I've traded options for a while. So instead of doing the married put, why don't I just buy a long call first and I'll have the same risk-reward profile? Or instead of buying the stock and buying the put, why don't I buy the put and then buy an in-the-money long call? So I have sort of this strangle position where I can profit on both sides and have less risk. Or instead of buying the stock at 58 and buying the put at 60, what if I had sold a cash secured short-term put, let's say for June 10th expiration, at the 59 strike and bought the 60 put? Okay, so then you'd create a calendar put spread. Bad graphic, I know, but there's a calendar put spread kind of, okay? Can you initiate it doing that? Yes. But you'll only be successful if you have the capability to select stocks that stay within a 1 to 1.5% trading range in the first month, and then if you get put the stock in the following months, have the potential to move up 5 to 6% or more. If you can consistently do that, you don't need to be on this webinar, and you don't need me to tell you how to trade. If you can consistently pick stocks that stay within a 1% trading range within the first month of trading, first 20 to 30 days of trading, but are going to move up 6 to 8% in the following 3 months after that, you don't need to be here. I can't help you. You're going to be much more successful than me. How can I say that confidently? And am I trying to put Asim's idea down? No, I'm not. Because when I first met Kurt 7 years ago, and he was a customer of Power Options, and he introduced me to RadioActive Trading, I had been trading for 5 to 6 previous years. And when I looked at the RadioActive trading techniques and read through the blueprint, guess what I did, folks? I said to myself, I'm going to do better than Kurt by selling an at-the-money 1-month out put and buying the 5 to 6 month out put option. So if I get put the stock, I've got a better cost basis. And if the stock moves up, I'll just continue to roll and roll the position, and I still have the protection in place. This is a bearish strategy. You're trying to force a bearish strategy onto a bullish stock. That's trading against yourself. I'm going to talk about that a little bit in a minute as well. At the same time, you might have a slightly lower, you're actually going to have a higher monetary risk, by the way. And your percentage at risk is going to be in that 60 to 70 to 80% of what you invested in the position. If the stock suddenly gaps up 10 or 12%, you get no further gain on the stock, you do not have a positive delta to the upside, and your put's going to decline roughly close to 50 or 60%. That's why it's tough, unless, again, and I mean consistent. When I say consistently, I mean 85 to 90% of the time, you pick stocks that just stay within a 1%, 1.5% trading range in the first 20 to 40 days, and then if you get put the stock the next 3 months after that, we'll move up 6 to 8%. And I'm not saying that to be rude. I'm not striking down your idea. It's the exact same idea I had. And I traded 5 stocks like that because I thought I'd do better than Kurt. And after the first 2 months, had I opened married puts, those positions on average would have been up 7%. My calendar put spreads that I was trying to use to manipulate it to get into the stock at a better price were down 12% of what I invested in the positions. Yeah, I used leverage, so I had less money in, but I was down 12% where it would have been up about 7. Okay? That, again, falls in the lie of leverage. And to go back to your self-esteem, is this trading against myself? If I'm bullish on the stock and I expect it to move up, why buy the put? Because in any strategy, you're going to have strings of winners and losers. And the key is, if you keep the losers to a minimum range, you're going to realize more profit on the upside on the ones that you win. It's insurance. It's not trading against myself. It's insurance. You insure your home, you insure your car, you insure your house. I'm putting $6,200, $12,000 into a stock position. I want to insure the downside. And not with a stop order, which we talked about earlier, which is assumed insurance. Why add the extra money to the position, increase the break-even? I already talked about that. The break-even only happens at expiration. This is not me being down $5.40 for buying that put on Texas Instruments. This is not me being $3.45 down as soon as I open the position. The key to remember is that I have 2 working assets. I have a stock and I have a put. It just so happens that the put protects the stock, which is 90% of what I, maybe probably more like 70%, 60% of what I invested in the position. But as the stock moves up, and we're going to show an example of this, we might go a little bit past maybe to 115, I do apologize for that, but as the stock moves up, guess what? I can manipulate that put option. I'm not really losing on the put as you'd expect, and I'm going to show that. And we already showed, wouldn't a covered call or spread be better? In one case, maybe. In Asim's question, if he did pick stocks consistently that just stayed within that 1% trading range, and he was only trading maybe diagonal calendar spreads or a covered call position, he would perform better than me over a 3-month time period if every stock that both he and I entered the same just stayed trading in a 1 or 1.5% range. Okay? I have 12 different income methods I can use in the situation the stock stagnates or the stock falls or the stock moves up. Okay? It's not just a one toolbox thing like a covered call, just roll the call or let it expire. Okay? But I am being honest here. If you find that 70 to 80 to 90% of the time you consistently pick stocks that don't move more than 1% in a 20 to 23 or 25, 30-day period, covered calls and cash secured naked puts, maybe even bull put spreads might work out well for you until you hit that one loss that's more than 20%. Okay, or on a spread trade, you hit the one loss that's even 50%. That's going to wipe out everything you just made on those other positions. All right, so I already talked about this. Don't necessarily consider the put as a wasting asset as an insurance policy. Yes, it is going to decline as the stock moves up. But as options investors, the reason why we buy that put 5 months at a time is we have the ability to manipulate that in our favor. I'm going to go through the 3 core principles fairly quickly. I still encourage you guys to send in questions at any time. And Asim, I'm not trying to be rude or shoot down your idea. You're asking the right question, and it's the same approach I did. I'm just trying to share with you my experience of why that doesn't work and the only way that could work historically to try to do that as well. All right. So the initial setup, what are the 3 core principles? And by the way, these are not just the 3 core principles of radioactive trading. These are the 3 core principles of any option strategies. Number 1, forcing an ideal size trade. Don't overtrade, don't overinvest. By purchasing the stock and the put, I am putting in more capital, which means I know how many shares I can trade, and how many shares I can afford to buy. And so by buying the put option with that, I might be risking 5% on the position, but I'm going to control it so that that maximum risk of 5% or so, 5.5% on Texas Instruments, that 345, or if I did 200 shares at $700 close, the monetary risk is only going to represent 1%, 1.5% of my total portfolio value. So even if I take the full loss, my portfolio is still 99% of what I had. The at-the-money bell curve. We already kind of touched upon this. Those of you that are selling, you know that the best premium is at the money. But maybe you want to go out of the money a little bit to get that better probability of expiring worthless. Or maybe in a covered call you're going in the money for a little bit of protection. But the at-the-money bell curve shows us two things. That when we're buying, we want to buy out of the money or in the money to pay less time premium. So we have a lower annualized cost. And of course, when we're selling options, we're selling at the money to get the best annualized cost. Those apply to both the income methods and the initial setup. And the red line decay, the time value decay. When we're selling options, we know that the shorter time we sell, the faster percentage-wise the time decay we're going to see. But those of you buying options, we know that when we're buying 3 months or 4 months out in time, the time decay doesn't hit us that much. This one's kind of obvious. We saw it with the trade simulator. Taking a risk of 7% or 50% of even the 100% maximum loss we could take on a credit spread is too devastating. This is where everyone gets hurt in the leverage spread trades, even leverage calendar spreads, even buying calls and buying puts. Because the risk is with buying calls and buying puts, we're going to overtrade. We're going to buy 10 contracts of a position, which might actually be $3,000 invested, and we can stand to lose 100% of what we invest in those calls. Having the risk too small, by the way, is also a problem as well. If I have 100% gain, that's not a big deal. If I only put in 15 or 20 cents, I'm talking about my other subscriber friend we mentioned earlier who's just buying out of the money long calls under 15 cents and is expecting to be wrong 90%. So he tells me he made 100% on his position. Great, you bought a call for 15 cents and you closed it for 30. Meanwhile, you had 7 other positions where you lost 15 cents on. How is that a long-term gain? He needs gains to be in the 1,000% or more. Okay. What is the biggest reason for having the right sizes to impact expectancy? All right, here, I'm going to show this real quick. This is the married put screens we would have seen for Apple. If I was looking for potential married puts on Apple following the radioactive trading techniques, again, on May 16th, a little bit more than a month ago, or a little bit less than a month ago. Well, Apple was at 93.88. Now, why am I showing you this chart? You see, with the stock at 93.88, someone might say that, okay, well, your January put at 92.5 is the cheapest one at $7.75. Why pay $32, $42, almost 50% of what you're paying for the stock to buy a put? The answer is I wouldn't, okay? But down here, this is the cheapest one, but look at the risk. It's at 9%. If I went to the shorter term July series and looked at a 90 put, which might only cost $2, well, my risk would actually be higher than this because the insurance policy wouldn't kick in until the stock fell. So what are we looking at? Expectancy and controlled risk, but reasonable. Would I love to be able to open this put here? This makes no sense whatsoever, but I'm going to show you. Buying the stock at 93.88. Buying a January 195 put for 101.70. Of course that doesn't make sense. I've got a net debit of 195.58 for the stock and the put, but I'm guaranteed to get 195 back, so I'm only risking 60 cents. Isn't that a good thing to do? I could sell a 60-cent call at the 95 strike, maybe 1 month out, and have no risk at all. That changes the whole position because now you have no profit between 95 and 195. If you go for these too low of risks, too deep in the money, your expectancy of profit goes quickly to 0 because you need such a larger movement in the stock in order to see the profit. The target range, as I mentioned, is going to be this at-risk level kind of in here, this 4 to 8%, keeping within a couple percent to maybe up to 12 or 15% in the money. Look at our strikes. Stock at 93, a 95 strike, 97.5, 100. These are all reasonable puts with reasonable risks, and if I'm expecting the stock to, let's say, go up to $96, $97, I'm going to have a lot of opportunities to make adjustments on this position and lower that initial at risk as well. So that's forcing ideal size trades, okay? That's what we're looking to do. Asim asks, is there a positive monthly cash flow strategy I can do? Well, there are income methods that you can apply to the radioactive trades, which we're talking about today, which will generate income and lower the risk. As far as what you're asking for is, will covered calls work consistently over time? Will credit spreads work consistently over time? Will iron condors monthly by month work consistently over time? If you're right, 80 to 90% of the time they will. That's the only answer I can give you. It really is. If you're less than 80% right, 85% of the time, you know, you're not right 85% of the time, I'm sorry. With the risk-reward ratio we showed you of looking for spreads that have that 80% probability, you will not be successful long-term. That's just the way the math works. It is inevitability. Okay, so you need to maybe be more dynamic and move with the market if that's what you're looking to do. When we look back at the trade simulator tool, I showed you standard collars, and that we could have a small profit being right just maybe 60% of the time, 65% of the time, looking for a gain of 2.5%, but keeping our risk down to about 5%. You still need to be right 65% of the time in order to profit. All right. Now the at-the-money bell curve, we all are familiar with this. It sets the standard for buying time cheaply when we're buying options, as well as selling time at a quality premium. Here's what you'd expect on any option chain. I'm going to show you an example of that in just a minute. When you look at any option chain for any expiration, the options that are closest to the stock price, terrible color to select on this graph. When they're the ones closest to the current stock price, the at-the-money options are going to have the highest time premium. Not the highest premium. The in-the-money option will have the highest premium. So if we're looking at a $50 stock, we could sell the 50 call for maybe $1.50. The 40 strike call is going to be worth maybe $10.50. Okay? But $10 of this is intrinsic value. The time value is only 50 cents. The 55 call might only be trading at 75 cents. So that's half of the time value that we have. So of course, if I'm doing covered calls and I'm speculating the stock's going to move up, or maybe I want to stay in the stock long term, I'm selling this out of the money call because I likely don't want to be assigned. And I'm collecting half the premium. The high premium is at the money. And as we go out of the money or in the money, we get the lower time premium. Okay, we might have to pay more intrinsic. Here's just a look of Apple's chart today, which is at 99.66. So those married puts, most of those married puts we showed for the historical chart on 5/16 for Apple would have been profitable or could have been adjusted today. But look here, with the stock at 99.66 today, as this morning, the 100 strike, our closest to at-the-money strike, the time value in percent time value is at 2.2%. As I go in the money down to the 95 strike, my premium is higher. Right, so stock's almost at 100. We've got about a $5.50 premium, but only 79 cents or 0.8% of that is time premium. This is for the July expiration, 38 days out in time. Same on the put side. The 100 put is priced at 242, right around that 2% time premium. On the put, as I go deeper out of the money, time value decreases. As we go in the money, okay, the value increases, but the time value decreases. And this is why we buy in the money. Put options, 1 or 2 strikes, less than 20% in the money, because we're paying a high premium, but we're guaranteed to get most of that back, and we're paying into a low time premium over time. The at-risk amount on the married put is only time value. That's all we're risking is the time value of the put option that we're purchasing. So when we're selling, we want to be in this range, and when we're buying, we probably want to be down here or in this range for the lower time value cost, to control the time value and be able to manipulate it better. All right, and of course, now simply the third core principle is the time decay line. Initial decay is slow, but becomes exponentially faster. We have one guarantee with radioactive trading, and any strategy, as an option approaches expiration, the time value goes to 0. Here's the standard expectation. If you're 120 to 90 days out to 60 days out, you see a lower time value decay. Once we start hitting 30 days out in time, 30 days closer to expiration, and in the last 30 days, it goes up, wow, sorry folks, it goes up exponentially. So what does that really mean to us as far as this goes? It means when I'm selling, I want to be selling in this range, don't I? Maybe even weekly, 7 to 10 days out to get the rapid time decay in my favor. But when I'm buying, I want to be over here. So the first month or first 60 days, the stock doesn't do as I want, doesn't do as I expect, I'm only going to lose a small value to time premium. Of course, if the stock goes up, we're going to see other things. But as you continue on, this goes back to Ken's question, in most radioactive trades, I'm closing the position. If it hasn't done what I wanted, I'm not going to hold it all the way to the time value of the put goes to zero and I just have intrinsic value left. That radioactive trade, I'm probably going to look to adjust it if I haven't yet when I get within 60 days to expiration. That's just one of the rules in the blueprint. I'm kind of giving away for free here today, but we usually close the positions when we get within 60 days to expiration if our expectations have changed and we don't see potential for further profit that we already have or curving the losses. So what about the summary of the 3 core principles? Forcing an ideal size trades, we control that automatically with a married put setup. The at-the-money bell curve, the initial setup, we're buying the in-the-money put, so we're paying less time value and maximizing and controlling our risk best. Would the out-of-the-money puts have lower time value if I bought them? Yes, but the stock has to fall in order for the stock or the insurance to kick in, so I'm taking more of those 10, 12, 15% risks. Jay says, you mentioned Delta. Is that in the blueprint? This might be a conversation for another time, Jay. I've done several webinars where if I run a search on power options and I put in just these 3 core principles into the search, which are already there in the default search for married put positions on power options or the RPM report, I look for stocks that are 150 to, let's say, 300 days out in time. I look for the risk to be between 3.5% to 7.5% personally, based on my criteria. And I look for the options to be no more than, let's say, 15% in the money. I'll run that search, and let's say, Jay, I get 20 results or more. Okay, I'll put in another stock criteria too, Jay, but let's just say I get 20 results. If I now look at Delta, in the search, I add that column Delta, I will see that all of the deltas on those 20 puts are already restricted to be between 0.55 to about 0.65 without me even screening by delta. Implied volatility is the same thing. I don't need to screen by delta. I don't need to screen by implied volatility because I'm already doing it. If the delta was too high or too low, it wouldn't have fit in that criteria. If the implied volatility was too high or too low, it wouldn't have fit into that criteria. So it's keeping it simple without throwing these confusions of what is delta, what is gamma, do I have to pay attention to this? I told I can only trade if I know what delta is. If you control your risk properly, if you follow the rules in the blueprint for the setup, you don't need to worry about that. You're already screening by delta. It's just, you know, an arcane term to kind of use to help sell books and things of that nature. Now, delta is not an arcane term. It's important to know what it is. But just by setting your criteria and looking for the controlled risk, you're already screening by those factors without having to worry about screening by them, is what it is. All right. Now, is that the end of the story? No. We already talked about this. When I open that initial position, after the stock moves, I'm going to apply 12 different income methods. That's what the blueprint teaches, 12 different ways. Instead of just having a covered call where I know, oh, I have to roll the call if the stock moves up, or I can take assignment, or I roll the call down. Okay, we have more tools in our toolbox to manipulate the time value, lower our risk, and generate income if the stock stagnates, if it moves up in price, or if it moves down in price. Okay, and of course the Siga model there, what are we looking to do? I open a married put. As I apply the income methods, I'm going to hope to shorten the risk level here. We're going to minimize the risk as we apply those income methods, and eventually we may cancel all the risk, which is called bulletproofing. So we have no risk on the position and still upside going forward. And the benefits of being bulletproof are quite obvious. No chance for a loss. Once I bulletproof a married put position, I have no chance for loss on the downside. I still may have unlimited upside, depending on what income methods I might have open. I can go through earnings without any concern of risk. The stock falls 20%, I still make a small profit. The stock gaps up 20% of earnings, I take more advantage of the upside. I can sit back and collect dividends, and I can withstand market corrections without the need for averaging down, which can happen when trying to manage a covered call, a cash-secured naked put, things of that nature. All right, so how can this play out? How can we better graphically describe what we saw for a scene? What other things can we look at? We're going to do that in 1 minute, but very quickly I want to show one more thing here on the Trade Simulator tool. After all that discussion, after showing how you need to be right 85 to 90% of the time with a standard credit spread portfolio, how you'd still need to be right almost 70% of the time on a standard covered call portfolio or cash secured naked put to profit long term. What if my expectations of target, of leaving the upside, are lower but still pretty good? Let's say 6% when I'm right. And let's say that I do control my risk here to be only that 5.5%, and I'm only expecting to be right 50% of the time. Well, here's one. Okay, it's outpaced gains. I'm right 63% of the time. I'm going to take that money to a high range there. I'm still only investing 20% of my $50,000 to each one. All right, I'm right 57% of the time. I only lose 5.5 when I'm wrong. I make 6% when I'm right. And I can still have a profitable portfolio, which was higher, by the way, than that one covered call portfolio where we were right 70% of the time almost. Everything was 68% of the time. We only took the portfolio up to about, oh, that was only 50,800. Okay, to get this number on the covered call, we had to be right about 75 to 80% of the time. How about this? It's not a great view, but even if I'm wrong more often than right, and remember, this is a guaranteed control risk in the worst case scenario. Those other strategies, when we talked about risk, we talked about the fact that I might set a 7% stop order on my covered call, but I could still lose 25% on a position due to an unexpected event. And so here we are looking at this here. I'm right only 47% of the time. I only lost about 4% of my total portfolio value. Less than that, actually. We only dropped it down about $123 or $1,200 on a $50,000 account. I'll try to look for one real here quick. Okay, there we go. That's what I was looking for. Even with this, with the proper setup, still able to take advantage of upside gains, apply the income methods, and shooting for a reasonable 6% return. It's very reasonable to expect. And controlling all your losses of 5.5%, you can be right only 50% of the time and long-term still profit. You will not be able to do that with covered calls. Even if you count it as my covered calls aren't losers till I close them, so I'm going to keep managing these losers for the 8-10 months it takes me to get back to break even. Are you really getting ahead at that point? What about the credit spreads? If you roll a credit spread out because it took a loss and you have to go out 6 months to roll down the credit spread to roll for a credit to repair it, well, now you're sitting on that capital for 6 months. Okay, is this reasonable? Making a 6% return on the married put positions that you open and controlling list to 5.5%? Let me click on track record here. And I'm going to choose mine. These are my actual radioactive trades that I've been using in the portfolio. And here what I want to show you is that my average gains on winners is 7.2%. My average losses to control to 4.7%. And I've been fortunate to be right about 60% of the time. So is 6% a reasonable target for an expectation of gain? Yes, in fact, even higher. Ernie does much better than me. His winners are closer to the 10% range, and he keeps his losses around 5% as well. Okay, I'm just showing you this. The Fusion subscribers can see all of our trades, and now even Greg's portfolio as well. But I just wanted to share that with you because that was the whole point. We showed the trade simulator tool, why those other strategies don't work, and we wanted to show you why this will work by controlling your risk. Even if you look for, and this might even be over a 2 or 3 month period, averaging a 2% gain per month when you close a radioactive trade for a 6% gain. But it still puts, again, the market odds in our favor. Trying to get back to that 50-50 one I had. Well, there's close enough. We can still be right only 50% of the time and show a profit. That's how we're stacking the market odds in our favor. But let's do what we came to do here a little bit more, and let's take a look. This is a covered call. This is a portfolio that I created this morning to show you some examples. Okay, what do I have? I have to put a seams question in here too, so we might take a brief moment. Let's do that. Let's take a brief moment to do that. Hold on one second here. We're going to have to use today's date real quick. All right, so here's what I'm going to do, folks. So I'm going to go to the chain for Texas Instruments, and let's go to chain. And I'm going to go historically back to May 16th for our other positions. All right, and Seam, remember, asked about, should I sell a short put in the position? Okay, well, where do we know about time value on our short put? The highest time value on the position occurs at the money. On May 16th, Texas Instruments was trading at 58.02. I'm sorry, I need the June 10th series. All right, pretty good premium. How about that? 58.02, we're going to take the at-the-money premium, 109 to 120. So I'm going to call it 115 premium selling that put. Okay, the cash secured, or not the cash secured, but the calendar put as a comparison to the married put. Let me go back to our portfolio. Let me enter in a new position. I want to enter a calendar put. All right. Now to enter the calendar put, what am I going to do in comparison? We're going to look at the other comparisons as well. I know I'm past the time here, but I'm going to be real quick with it, but still educational. So we're going to select this week's expiration, June 10th. And I said the 58 put, we're going to sell that for 115 on May 16th. Date's not really important, but let's be accurate here. And we're going to do 4 or 5 contracts, okay? So I'll put 5 contracts in as well. What am I going to do? I'm going to buy the same put that I was going to show with the married put. We bought the 60 put at 540. Same date. Fantastic. All right, 5 contracts as well. Not include commissions. Let's go. All right, so let me highlight some things for you folks here. What are we looking at in this mess of numbers? Here is my married put on Texas Instruments that we talked about. Buy the stock at 58.05, buy the put at 540. Total investment in, of course, we knew was 63.45. Here, total invested in. Gain right now, 3.4%. Okay? All right. Now, what are my other comparisons on this position? At the same time, I could have opened the long call. Rather than buying Texas Instruments for 63.45, we could have bought the January 60 call for 340. Now, if I bought 5 contracts, I still would have only put in about $1,500, $1,700 into the long calls. And look at the return so far. We have a 43% gain, or 738. Clearly, this is a better position, isn't it? Buying the long call. Well, no, it's not. Remember, let's toggle between some views here. I'm going to go to the profit and loss chart. Remember the married put position that we saw earlier on Texas Instruments from May 16th. I did invest $6,300 to control the risk to single-digit percents. My monetary risk is only $345, or 5.4%. We saw in the portfolio that we have a gain on this married put right now. I believe it was about maybe 2% or so, maybe a little bit higher. Okay, so we do have a gain because the stock has moved up. It's trading at 61.86. Yes, the put's gone down in price. We're going to talk about that in just a moment too. But in the worst case scenario, if the stock fell, I could only lose $345, which is 5.4% of what I invested and less than 1% of my total portfolio value. If you decided to use leverage and went with the long call, would you only buy 1 call of Texas Instruments at 340 to say you're only risking at 340? No. You would have bought 5 contracts, maybe even 10 contracts, and said, hey, if I buy 10 contracts, I'm only investing $3,000. I have half the investment that Mike put in to his RadioActive Trade. But guess what? You're risking 100% of what you invested in the position. If the stock went the other way and fell down to $55 per share on or around today's date, your investment would go down to $815. The value of your 5 calls would only be $815 theoretically, which means you're losing 50% of what you invested in the long calls. Whereas in comparison on my married put, if my stock dropped down to $55 in the shorter term, what date did I select, folks? Let me keep it fair, 6/14. Okay, so on the married put, the stock drops there to 55 on the 14th, I'm only losing $123, which is less than 1.8% of the maximum risk. Well, it's 1.8% of the total invested, but it's a third of the loss I would take in the maximum risk. That's forcing an ideal size trade. Did the long call, I know this looks the same, but did the long call give me the same risk-reward profile? Yes, but now you're falling into live leverage. Now, I can't deny these results here. The monetary gain on the long call is 738 versus 216, or 3.4% for my married put position. Okay? But again, long term, if my next trade drops 10%, or 6.6% is where the stock is up from where we would have gotten in, if my next position drops 6.6%, that's going to be a 25 or 30% loss on the long call you bought. Does that counter to 43% gain? Probably, but how many times can you withstand that? Whereas in this case, 3.4% gain, if in the first 10, 15 days my stock drops 7%, 8%, I'm going to get out with maybe that 1.5, 1.72% loss, and my gain has already countered it. Okay? What about the covered call? Well, you can see here, remember what we were talking about. If I bought Texas Instruments on May 16th, to maximize the time value, I might have sold the June 10.58 call. At the time, just as we did, I looked at the historical chain, it was priced at 115. So the maximum return for the at-the-money call that had the highest time premium for today's expiration, which would have been about 3 to 4 weeks out in time from May 16th, was 1.9%. Now, would I buy this back now and roll it to a higher strike? No, it's going to cost me over $3 or so to buy to close this option. Actually, almost close to $4 to buy this option. I'm putting more money in. So if I sold a 62 strike to roll for a credit, I've got to go to a far out in time. So yeah, you made 1.9%, that's great. But with the move in the stock, the 6% move, I'm making 50% of what I expected to make in the move in the stock. Not quite double what you could make in the covered call, but right now, if you liquidated the covered call, you'd make 1.6%. The married put is double that. Again, is that going to be every situation? No. If the stock had moved up just 1% or so, you'd be close to the maximum gain of almost 2% on your covered call. I'd be at about a 0.4, 0.5% gain. Okay, but the market moves a little bit more than 0.5% over a 20 or 30-day period. We've been in a position for 24 days. All right, one other comparison here, the bull put credit spread. So with Texas Instruments still at $58, I could have sold the 57 put. Why am I not selling the out-of-money put? Because I wanted that 70% probability. So we could have sold the 57 put on May 16th for 78 cents. Bought the 55 put for 31, so we get a net credit of roughly 47 cents. Of course, we're probably going to use 10 contracts. What's the point of using leverage if we can't use leverage? So we're making about 47 cents off a $2 risk, so we're going to be risking 153. We use 10 contracts, of course, in this position, then we're going to have a maximum risk of 1530, which is 5 times what I'm risking in the married put. If the stock fell to just $55 per share, I'd have the maximum loss in this bull put, and as we just saw, if the stock dropped to $55 per share on June 14th, I'm only losing $140 or so on the married put. Would have lost 50% of what I invested into the long call, and I would have lost 100%. Is this a higher monetary profit right now if I liquidated the bull put credit spread as it is compared to what I'd have on the married put or the covered call or the long call position? Well, it's at 530. Okay, well, the maximum we thought was 470, so that's the maximum return we could get. Using the midpoint prices is showing us we could liquidate, but it's probably closer to 470. Not going to be able to make more than that. But yeah, I could probably close the bull put now for 470. But remember, in order to get that $470 close to profit or expiring in one day, I had to risk $1,530, which is 5% of my total portfolio. Whereas here, I'm only risking $345, remember, or about 1.5% of my total portfolio. And we have a gain right now, maybe about half of what we see on the bull put. But is the risk-reward ratio justified to what you want in your trading account? This is why I don't trade credit spreads with 40, 50, 60%. Yes, the potential for high returns are there. This was a 30% return. It was a little bit exaggerated of what we'd expect an 11% yield on a bull put credit spread, especially on a standard stock. But again, it is possible, but I still have to be right 85 to 90% of the time to make that successful. Here's your calendar put spread, Asim. I hope you're still here. You can see just by the numbers. I did 5 contracts. So we had a total investment of $2,125, or 1/3. Best case scenario is that tomorrow, on June 10th, the stock's trading right at our short put strike price at 58. It's above that. And where's the problem? Stock moved in your direction, you're losing. All of the other bullish strategies show a gain. You took the same loss on the put, well, more contracts because it's a leverage trade, so you would have traded more contracts. But you're losing more monetarily on the put than we are with the married put position, the cash secured put position, okay? And you're not gaining anything else but that 115. The stock has moved up more than double that. So you have a negative delta and you're losing money on this position. Okay? Of course you could say, well, I could manage it and I could do different things, but let's take a look at the profit and loss chart. What would we have done on May 16th with our calendar put spread? We would have bought the same put we were interested in for our married put position, the January 60 put, and you would have sold the at-the-money January 58 put for the best time premium. Here's your profit and loss chart. The best case scenario, again, I already talked about this, is if you pick a stock that does not move by more than 1 or 1.5% in the first 20 days, and then you put the stock and it moves up after that. Here you're in a 12% loss on the leverage. And look at the numbers again. Remember what your total loss is. Okay, you might not realize that to closer to January expiration, but your loss is about 7 times what I have on the married put position. Your potential max return was 630, which is more than 3 times what I'd make right now on the married put. But remember, the married put, just like the long call, has that infinite upside profit potential. So if the stock did gap up to 68 or 70, you're closer to that, half of your maximum risk, $1,000 on the position. We'd be looking at a profit probably of around let's see, 68 there, probably around $700, $800 on the investment of the married put. All right, last example. Okay, and the last example, a lot of investors, the first thing they look at, they see the married put, and they ask the right questions just as Asim did, and what some of you did. Wouldn't the long call work better than the married put? In this case, monetarily and percentage-wise, yes. But is the risk worth it? Because you're never just going to trade. It is not a parity trade to the married put. If you want to do a parity trade to the married put, and you saw me enter this Texas Instruments position by buying the stock and buying the 60 strike put, the parity trade is to buy 1 call of the Texas Instruments position at 340, 345, and leave the remaining $5,800 in capital you would have used to buy the stock on hold in your account and not use it to make other investments. But we all know what a long call investor is going to do. Even if you did only buy 1 call of the January 60 call for Texas Instruments at 340, you would have taken the remaining, let's say $6,000 I put into the married put, and you would have bought maybe 2 contracts of stock XYZ, 5 contracts of stock ABC, 10 contracts of stock 1, 2, 3. Well, over the last month, not all stocks moved up, but over the last month, you would have looked really good. And then if you do that for the next month, but the market pulls back, you're probably giving back everything you made with your previous 5 wins for the 50 to 60% losses you could take on the long calls. I trade strangles, I trade straddles around earnings and things of that nature, but buying calls and buying puts is not a large part of my portfolio. All right, now, on the other side of that, the next question that comes up is, well, I still want to use leverage. And if the put can ensure a stock position, it can ensure a long call position. So rather than buying the stock at 58, buying the 60 put at 540, why don't I buy an in-the-money call? And so that way, what we see over time is that I'll be able to have less money into the position. Okay, well, let's do 1 contract here to be fair. I have 5 in there now because most likely using leverage, you'd put more money into the position. All right, but here we go. Let's just do 1 contract. So if you just did 1 contract of this in-the-money strangle, you're trying to substitute the stock for the put, well, you're going to have a lower cost basis, about 1/5 to 1/6 what I had invested. Your monetary risk is double what I had, and remember that represents 56% of what you invested into the position. Now, what did we see with the married put? Remember, the married put position, we have a positive delta. as the stock moves up, I'm gaining 1 delta on the stock. I'm only losing 0.6, 0.5 on the put option. When you enter the in-the-money long strangle, you're not delta neutral when you open the position, even if you go deeper in the money. Okay? Even if you go deeper in the money, then the problem there is the fact that you're delta opposed, not delta neutral. It takes more movement for the stock to go one direction or the other before the gain in your call starts countering the loss on the put. So where I'm on a positive gain right now on the married put position because the stock moved up in price, we see here that on the in-the-money strangle, with 5 contracts, you lost 825, same as we would have with the calendar put spread buying 5 contracts. And I did gain $1,100 on my call. So my call moved up from $6 to $833. So I've made $233 on the stock and lost $1.65 on the put. So that means that you're making 70 cents. Right? You're getting $233 on the call now, even with a 6% movement on the stock, and you're losing $1.65. The leverage is working against you now. Okay, so we'd need the stock to, you're making a profit of 70 cents, which is a third of what I'm making on the married put position. Okay, all right. So I did have some popular questions come in. Jay says the secret is getting 60 to 70% of the stocks right. Do you have a method for picking winning stocks? Yeah, that's what we talk about in the blueprint. I mean, the techniques that we use, the criteria that we use for picking the married puts, that's what's there. I've been fortunate with my standard caller positions as well to make 60, 70% also, be right 60 to 70% of the time. Okay? All right. Shasad says, I need to see Alyssa's presentation more closely to really understand the comparison. I make 2 to 3% on $1,000. It's $20 to $30. Yeah, that comes into the cost basis, okay? And the cost basis, you're making 2 to 3%, but earlier we talked about forcing an ideal size trade in the presentation. And what is forcing an ideal size trade? There is such a thing as too little risk and too little profit, okay? So sure, you can tell me that you made 100% gain on a position, and that's fantastic, but if you only invested 15 cents into an out-of-the-money long call, well, you made 15 cents on 15 cents. I'm happy for you, but you got $30, okay? Now, you're making 2 to 3%, and if you're doing that consistently, that's okay. What is your loss? When you take a loss, is it 4 or 5%? Because now you've just wiped out 3 previous trades. That's the risk. In addition to forcing an ideal size trade and the idea of too little at risk, there's also maybe too little invested. You cannot expect to trade option strategies with $1,000 and expect to double or triple or quadruple your portfolio in a 1 or 2 year time period. That is unrealistic. I don't care what strategies you're doing. I don't care what kind of leverage you're using. It doesn't matter what kind of elaborate spread trade of a broken wing calendar butterfly with a back ratio spread you're using where you technically only invested $500 and you have the potential for a 2 or 3 or 4% gain on the position. You're not going to be able to double your money. Unfortunately, yeah, the strategy we're talking about to be able to control the risk effectively, to put the market odds in your favor with a 5 or 6% risk instead of a 40 or 50% risk of what you invest in the position, which we see with credit spreads, calendar spreads, buying long calls. Again, you know, a 10% decline on a security, if you have a long call, your long call is going to drop 30 to 40%, maybe more. Okay? With a 10% loss on a married put, I'm only going to lose maybe 1.5%, 2% of what I invested into the position. But in addition to that, the answer, and Jay just asked about this. Yes, this is being recorded. I'm going to send an email to everyone later on so that you can review that as well. Okay, so oh, shoot. Sorry, I just forgot something there. All right, so I did want to go ahead and show those comparisons there for everyone regarding what would a long call have looked like and what's the risk-reward trade-off. What is a covered call would have looked like using the at-the-money covered call? Same thing. Okay, and what is the difference between how the married put would have performed based on these other ideas? Okay, Jay says he's still not clear. Well, okay, so Jay is saying if he runs a search for the married puts and he gets Texas Instruments, AT&T, and Facebook, which one is the best one? Will the blueprint show me which stock is better? In theory, yes. And I'll tell you right now that well, it does. I mean, looking for what Ernie and Kurt would look for consistently, they would tell you with those three choices, looking at the married put, if the at-risk amount and the monetary at-risk amounts were the same, I'm probably going to say that both Kurt and Ernie would trade Facebook. Okay? AT&T is probably too low of a volatility, and that's discussed in the blueprint. Okay? You want to see some motion. You want to see some movement on the position to be able to see better opportunities for the different income methods. Why would Kurt and Ernie choose Facebook and I chose Texas Instruments? Because at the time when I opened Texas Instruments in my account, I was looking for a more stable security that paid a decent dividend for a longer-term growth radioactive trade. If at the time I was looking to open a new married put and I wanted to see more potential for income, I would have chose Facebook. Okay? I'm not saying Facebook's bullish. I'm not saying Texas Instruments right now is bullish. In fact, I think we're due for a little market correction. That's why most of my risks have been reduced on most of my open married put positions. But yeah, it does discuss that, and it depends. There's two factors discussed in the blueprint. Are you looking for RPM? You're going to want to mix in your portfolio, but at times you're going to look for an RPM for longer term growth, and at other times you're going to look for one for ability to apply income methods faster, and at the same time, using the ones with those lower volatility. I've had great success in the past with trading married puts on Kraft and Johnson & Johnson, for example, but it was more because the stock moved. I think Johnson & Johnson moved up 26% in the 5 months I was in the position, and Kraft moved up 18%. That's why those trades were so successful. If they stayed within a tight trading range, as they normally do because they're lower volatile stocks, I would have still had a profit, but it wouldn't have been the double-digit profit I had. It would have been single-digit profits, which is acceptable, but a lot of that would have been due to the dividend and then an occasional income method. So yeah, if you want AT&T, you're going to have the expectation that AT&T is poised for a larger move because it's less volatile and you won't have as good premiums to apply the different income methods. Whereas Texas Instruments, good premium still available but does pay a decent dividend. I'm looking at that as more longer-term growth. Facebook would be more volatility shifting month by month, ability to do income methods on a more regular basis as well, and could profit more long-term. That about covers it for what I wanted to teach today. And I'm not even going to give anyone a hard sell right now. Here's what I'm going to show you is coming up next. On Tuesday, June 14th, we're going to take this a little bit further. We did a lot of it today, and I didn't mean to, but we're going to show what is more possible with the radioactive trade. I didn't show how I would adjust that Texas Instruments position today. I could take the risk I have of 5.4% that we started with, 345, and get it down to almost bulletproof status with 2 moves, and still expect to collect a dividend, which would cancel all the risk, and I could still do more adjustments in it over the next 2 months. Okay, we could easily reduce the risk by 50%. I could drop that risk from 5% down to 2% with just 1 move, and still have 6 months of protection in place. Okay, but that's what we're going to discuss on June 14th. If you go to radioactivetrading.com on the right-hand side, you'll see the next webinar coming up, What is Possible with Radioactive Trading. Also, I want to encourage you to go to Radioactive Trading. Check out that trade simulator tool I showed twice today, or showed a couple times today. Put in your numbers of your expected gain, your target loss, and your probability of win-loss ratio, and see how your trading plan would plan out over time, and if the married put setup would work better for you. Instead of asking you, Kurt does this a lot, and there's nothing wrong with that because it's teaching you by asking you questions, but he typically asks, based on what I've shown, if you had limited all your losses last year to 6% or less, would you have a better trading year? Why am I not asking that question? Because for 6 years, almost twice a week, Kurt asked that same poll to educate his attendees and to make them say, yes, I would have, and to realize and reinforce what we've taught. But the same results always come up. 70% of the audience says, yes, that would have helped me with my trading results. 10% say, I would have been up greater than 50% had I limited my losses less than 5%. And very rarely, 0% to 1% say that that wouldn't have helped their trading results over the last year. Okay? So I'm not running that poll because I know it, but I'm just going to tell you what I'd expect the results to be. But anyway, check out the blog for more information. Check out the free resources. All of this is leading up to on Thursday, June 16th. I'm doing a webinar for Blueprint owners only where I'm going to review the 12 different income methods, what's discussed in the Blueprint, when to use them, how I use them, what things to look for, a little bit more insight into when to use each of the income methods and maybe when not to use each of the income methods. But that's going to be available for Blueprint owners only. So if you want to see what the next step is, check out the blog. And of course, sign up for the webinar on Tuesday, June 14th at 12 p.m. Eastern Time is what is possible with RadioActive Trading. We'll expand on what we saw today and take that next step in preparation for the review of the 12 income methods for Blueprint owners only on June 16th. And if you're considering the Blueprint now, you want to consider picking it up, go to radioactivetrading.com/iridium, and you'll be able to see all the special bonuses that we currently are offering if you pick up the Blueprint. And of course, you'll get the invite in the near future, probably Monday or Tuesday, to that special webinar that we're hosting on Thursday, June 16th, reviewing the 12 different income methods. So I sent that link to everyone in the chat. It's radioactivetrading.com/iridium. You go to there, you'll see the special offers for the blueprints. Yeah, Iridium. Did I spell it wrong? Yeah, IRIDIUM. And I sent it there in the chat window, radioactivetrading.com/iridiumj. So that's where you can do that. Okay? All right. All right. Well, it looks like... let's see, I'm going through some of the other questions here. Harry says, for income replacement strategy only, for cash flow only, what do you suggest? The only thing I can suggest, I guess, Harry, and I kind of touched on this twice, if you're really set on any time you do income generating, month by month or week by week, you're getting a trade-off. You're capping your gain one direction or the other. It's inevitable. You can't not do that. If you do a back ratio spread, sure, but now you're not generating premium, you're paying a debit to get into the back ratio spread, call spread or put spread, okay? So if you want monthly cash flow income, but you want protection, the only thing I can answer for you is that you want to look at standard callers, okay? Buying the stock, selling an at-the-money call, buying an out-of-the-money put. You're going to be looking for maybe a 2% max gain to the upside and try to keep your loss only 5% on the downside. I still use that with a portion of my account. I have to be right about 65% of the time to be successful with that strategy, and I've been fortunate enough to be. That's why I still trade it. I've been trading it for about 13 years or so. Why am I trading 50% of my portfolio with radioactive trades then if I'm having that success on the collars? Because my success with radioactive trading is almost double or triple what I'm seeing with the standard collars. And that standard collar percentage I'm talking about, making 2.5% when you're right, only losing 4.5%, 5% when you're wrong, and having a positive premium but a smaller cash flow month by month by month, still takes advantage of the limited risk. But again, you're talking about smaller percentage gains, and I've just personal trading, I've well outpaced what I make with the collars. But the collars are still more profitable for me than the year and a half I traded covered calls, cash secured naked puts consistently in a portfolio, allocating 30 to 40% of my portfolio to credit or debit spreads. The collars perform better than that. The radioactive trading techniques perform better than the collars, but that's why I still use collars. They perform better over time than the other strategies, and it's because the risk is controlled as well. All right, now if you think of further questions later on, I'm sorry I went a little bit longer, but I wanted to cover a lot today, and I think we did, and you guys posed the right questions where it guided me to where I wanted to show you to the different comparisons and the different ideas to help reinforce why using the radioactive trading techniques is so important in your portfolio. But if you have a question later on, send me an email to support@radioactivetrading.com. You can also call us during market hours here at the office at 302-992-7971. I'm not going to be available for the next 10 or 15 minutes, but someone might be here to help take your calls as well. And Harry, if you do have other questions about the collars, I didn't really illustrate them very well, and because this is focused on the radioactive trading techniques and why I use these with more of my portfolio than the collars, even though the collars are successful, it's because I'm more successful as well. And so remember, everyone, back one page, check out radioactivetrading.com. You can register for the webinar on June 14th. We'll take the next step. You can check out the free resources and blog, and I encourage you to play around with that trade simulator tool. And if you think you're ready for the blueprint, go ahead and dive in. You'll see the special bonuses there. It's radioactivetrading.com/iridium. And then on June 16th, we'll have that special Blueprint Owners Only webinar as well. Well, thank you for joining me once again, folks. Have a fantastic trading week. We'll probably see you sometime soon in the next few days on one of our online presentations. Happy trading. Have a great weekend. Good night.